Warning: China's population decline to accelerate, undergo major changes. China watches manufacturing activity shrinks for fifth straight month, waiting for Bazooka-Like stimulus. Country garden posts record loss, warns of possible default. It's all covered in today's China Truths. Warning: China's population decline to accelerate, undergo major changes. One of the underlying reasons behind China's economic slowdown is the collapse in demographic data, and its population is projected to experience an absolute decline, beginning from 2023. Last year, China's population fell for the first time since 1961, a milestone that had not been expected to occur until 2029 or later. From now on, the decline is expected to accelerate. Late last year, the United Nations predicted that China's population would plummet from 1.43 billion in 2022 to less than 800 million by the end of this century. It's worthy noting that only with plagues and famines dating back to the late Middle Ages has such a severe depopulation occurred. China is following the model of other high-savings, high-investment economies in Northeast Asia. Economic systems that suppress consumption and living standards will eventually be retributed. They create large numbers of stressed young couples who do not want to have children. As a result, China has one of the highest costs of raising a family in the world, which has also led to a historically low fertility rate that has fallen to an all-time low of 1.2 children per woman. In 2021, the Chinese government adopted the three-child policy to encourage fertility, but the fertility rate fell short of the control of central planners. China's lowest fertility rate also reflects distinctive Chinese characteristics, especially the Communist Party's authoritarianism. Due to selective abortion and neglect of female babies, China's female population is about 30 million fewer than its male population. Since China continues to see a net population outflow, it cannot solve the problem by attracting foreigners. Migrants and ambitious people tend to shy away from aggressive authoritarian regimes. The rapid decline in China's population has brought a double blow to the country's prospects. Fewer workers mean lower economic growth. Over the next 75 years, China's working-age population is forecast to shrink faster than its total population. At the same time, an aging population will exacerbate pressure on increased welfare spending, as evidenced by the tens of thousands of elderly people taking to the streets to protest health insurance reform in Wuhan and Dalian this year. Even if the population falls below 800 million by 2100, China is still expected to remain the world's second most populous country, with a population twice that of the United States. But China will undergo major changes. Its role as a brutal rule-breaker gobbling up export markets and clamoring to buy companies and real estate will diminish. It will be more like a cantankerous ruler, worried about its crumbling welfare system and stubbornly low economic growth. China watches manufacturing activity shrinks for fifth straight month, waiting for Bazooka-Like stimulus. Chinese manufacturing activity shrank for the fifth consecutive month in August, as the services sector slumped to its lowest level this year. The National Bureau of Statistics Manufacturing Purchasing Managers Index, PMI, edged up to 49.7 in August, from 49.3 in July. Anything below 50 indicates contraction. While that topped the consensus estimate of 49.4, the monthly reading has been stuck in contraction territory for 8 of the past 12 months. New orders and buying activity rebounded, expanding for the first time since March. But export sales tumbled for the fifth straight month. The official non-manufacturing PMI slipped to 51.0, from 51.5 in July. The print came in slightly below market estimates of 51.1. Despite recent indicators highlighting deflation, the manufacturing and services PMIs hinted at reviving inflationary pressures due to rising input costs that usually lead to increasing output prices. Mr. Zhao Qinghe, a senior National Bureau of Statistics official, said, "The survey results show that insufficient market demand is still the main problem that enterprises are facing, and the foundation for the recovery and development of the manufacturing industry needs to be further consolidated." The private sector version of the manufacturing PMI from Caixin will be released on August 31st. That's also expected to be in contraction territory. Markets were mixed on the news. The Hang Seng Index rose by 0.5%, while the Shanghai Composite Index slipped by about 0.2%. According to ING economists, the latest manufacturing and non-manufacturing PMIs point to an economy that is neither growing nor shrinking. They wrote in a note, the forward-looking elements of the service sector PMI index remain in contraction territory, unlike their manufacturing counterparts, and that suggests that the headline index has probably not yet troughed and will fall further. A glimmer of hope may be in the export series, which, while clearly continuing to signal contraction, did fractionally rise this month. Overall, though, both series seem to be converging on a point close to 50, consistent with an economy that is neither expanding nor contracting. Things could be worse. But markets are not likely to take too much comfort from this set of data. The bad news about China's factory activity and non-manufacturing activity are putting pressure on Beijing to reverse the economic slump and provide support to shore up growth. Yet, while the Chinese authorities said last month that they are trying to drag the economy out of a crisis, there is little that Beijing can do to fix the economy swiftly, said an expert. Mr. Robert Carnell, regional head of research for the Asia-Pacific region at ING, said, although it is a widely held view that the government needs to do more to help rescue the economy from its current state, exactly what it needs to do is being actively debated. According to Mr. Carnell, more policy rate cuts will be good, but that's not easy because China also has a problem with the currency weakness, and rate cuts undermine the profitability of the banks as well. Similarly, massive government investment in infrastructure would be beneficial, but it would also lead to massive debt, which is undesirable. He added, so there are many things the government could do, which would be nice. But there aren't very many things the government practically can do to give the slumping economy a quick fix. National Bureau of Statistics also added, after a flurry of trade, manufacturing, and retail statistics in July, the PMI provided the first indication of how the world's second-largest economy performed in August, and the weak numbers are maintaining pressure on officials to announce more policy measures. Struggling economy waiting for Bazooka-Like stimulus. In recent months, data have confirmed that the Chinese economy is experiencing a slowdown despite hopes that post-pandemic conditions would lead to an exceptional boom. Instead, the world's second-largest economy has seen retail sales easing, rising unemployment, cratering exports, and a falling Chinese yuan. The collapse of Evergrande Group and Country Garden, the two largest property developers in the nation, added to the country's economic woes. China is also struggling to recover from a domestic and foreign debt crisis that is threatening the country's economic development, financial security, and global clout. While official numbers are unavailable, according to Statista, the national debt is projected to rise $15.6 trillion by the end of 2023, an increase of $1.8 trillion from 2022, pushing China's debt-to-GDP ratio to a record high. The main drivers of China's debt growth are the local governments and the corporate sector, especially the state-owned enterprises, SOEs. Local governments have been borrowing heavily to finance infrastructure projects and stimulate economic growth, often using off-budget financing vehicles that evade official scrutiny and regulation. SOEs have been leveraging to expand their market share and support Beijing's strategic goals, such as innovation and industrial upgrading. However, both sectors face low profitability and high default risks, posing a threat to the financial system and fiscal sustainability. Because of sluggish growth, officials have started employing fiscal and monetary stimulus measures to bolster the economic landscape. Over the past week, Beijing has taken a focused approach to help the economy, ranging from steps to increase lending and stock investment to more tangible measures to increase home demand. Officials are attempting to expand credit to consumers and businesses by encouraging banks to lend more. Mr. Ma Jianyang, the deputy head of the Financial Market Department, reportedly plans to make the case to financial regulators, large companies, and lenders that banks need to expand loans to businesses that are borrowing for the first time and establish annual targets for services to private entities. In July, Chinese banks extended $47.5 billion in new loans, the lowest amount since November 2009. Household and business loans tumbled in July. Moreover, outstanding loans climbed by more than 11% in July, the smallest percentage so far this year. The Chinese offshore yuan is poised to hit a record low this year. The offshore yuan, which is mainly used by businesses and investors outside of mainland China, could plunge to 7.6 against the US dollar by the year's end. It's already down by more than 5% year-to-date against the greenback. As of August 31st, the USD/CNH currency pair was trading at about 7.3. Officials have intervened in currency markets to support the yuan. In August, authorities confirmed they would allow the yuan to trade at a 2% band relative to the daily fixing each day. A recent PBOC paper suggests that policymakers possess other tools to stabilize the foreign exchange market, such as using the Forex Deposit Reserve Ratio, Forex Reserves Ratio, and macroprudential factors for cross-border financing. The yuan, as the worst-performing Asian currency this year following weaker-than-expected activity data and prolonged weakness in the property sector, has also been one of Beijing's headaches, prompting the authorities to initiate a policy rate cut 2 weeks back. However, the unexpected reduction of China's main policy rates by the People's Bank of China, PBOC, on August 15 added depreciation pressures on its currency and led to capital outflows, as foreign investors sought higher returns elsewhere after losing faith in the economy. But it is not only the broader economy that is struggling. The financial markets are slumping too. For the first time since April 2008, the Chinese regime reduced the tax on stock trading from 0.1% to 0.05%. The Ministry of Finance and the State Administration of Taxation said in a joint statement that the goal behind the tax cut was to revive capital markets and lift investor confidence. In a separate August 27 announcement, the China Securities Regulatory Commission outlined several measures to improve investor confidence. The nation's chief stock market watchdog aims to slow the pace of initial public offerings, decrease the amount of collateral that traders must hold with their brokers, and implement restrictions on how major stockholders in publicly traded companies can sell their shares on the stock market. From economists to traders, the world is waiting to see what the Chinese regime will do to stimulate the anemic economy. But while analysts will wait for fresh data in the coming months to determine whether the government's efforts are resulting in gains, many experts believe that Beijing needs to fire off a bazooka-like stimulus to support the economy. Whether officials have enough tools at their disposal or not remains to be seen. China's economy is not moving forward. Local governments in China have increased their borrowing rates for infrastructure construction, a trend that has the potential to stimulate economic expansion. In addition, Beijing recently promised to increase government spending. On August 30, the central bank met with businesses and financial institutions to improve private sector access to finance. Still, China's property slowdown, weak consumer spending, and falling loan growth threaten Beijing's annual GDP growth forecast of approximately 5% this year. Economists at major banks, such as Morgan Stanley and UBS, have recently lowered China's GDP projections for 2023, citing less than expected governmental support. According to Mr. Carnell, the only good news in these numbers is that the contraction is happening at a slower pace, which is better than a spiral southward. However, the manufacturing and non-manufacturing sectors appear to be converging at 50, which means that the economy is still struggling by moving sideways, which is a concern because the economy is not moving forward. The economy has not bottomed out yet. Country Garden posts record loss, warns of possible default. Late on August 30, Country Garden released its first-half financial report. Reports show that China's largest private real estate developer suffered a record net loss of $6.72 billion in the first half of this year. Country Garden warned on the same day that it faced the risk of default. Country Garden said the company's net loss reached 48.9 billion yuan, $6.72 billion, from January to June 2023, compared with a net loss of 6.7 billion yuan in the second half of 2022 and a net profit of 612 million yuan in the first half of 2022. Country Garden said that in the first half of the year, revenue increased by nearly 40% year-on-year, but the cost of sales soared by 73%, and the company's total liabilities were the same as the end of 2022, at 1.4 trillion yuan. Country Garden warned on August 30 it would face the risk of default if its financial performance continued to deteriorate and said it felt deeply responsible for its record losses in the first half. Country Garden said in a filing, if the group's financial performance continues to deteriorate in the future, it may not be able to honor the financial covenants of these borrowings, which may lead to defaults on these borrowings and cross-defaults on certain other borrowings. According to Reuters, analysts at a foreign investment bank said investors were looking for details on short-term debt and new bank loans to better understand Country Garden's cash flow. A company official told Reuters, with most of the funds locked in escrow accounts with project contractors to ensure delivery of houses for the next 2 years, there is little cash left to repay group-level debt. The official added, about 60% of the company's total onshore bonds are due in the remaining months of the year, and if the company can extend the repayment period, it may be able to improve its operations and cash flow. Country Garden said in a statement that it was caught off guard by the depth and persistence of the market's downward trend. Country Garden also said it invested too much in real estate in smaller cities, where the recession was more severe. Before the financial report was released, Country Garden's share price closed down 3.3% on Wednesday to 88 cents per share. Investors are closely watching Country Garden's latest financial report for details on the company's cash flow and how it is coping with debt. They worry that the real estate giant's liquidity crisis could spread to China's wider economy. The company's liquidity crisis has come into focus since Country Garden failed to pay a combined $22.5 million in interest on $2 denominated bonds earlier this month. Country Garden is also seeking to extend the repayment period of an onshore private placement bond. Since the end of 2021, China's real estate industry has seen a number of corporate defaults, including Evergrande Group. Bloomberg said, the debt crisis facing Country Garden could be worse than when peer China Evergrande Group defaulted, because Country Garden has 4 times as many real estate projects as Evergrande Group. The company announced earlier on August 30 that it plans to repay a loan by issuing $34 million worth of stock, the latest sign of a cash crunch. Bloomberg intelligence analyst Christy Hung said ahead of Country Garden's earnings report, with sales going downhill, there won't be a big turnaround in the earnings outlook. On August 10, Country Garden admitted that the company was facing its biggest difficulty since its establishment in 1992, citing deteriorating sales and a difficult refinancing environment. The news triggered a wave of selling, forcing Country Garden to suspend trading in 11 onshore bonds. Don't forget to leave a comment in the section below to share your opinions on today's topic with us. Make sure to like and subscribe to see more interesting topics from China Truths.